Welcome to the last session of our conference. This session is chaired by Professor Marek Dąbrowski. Professor, the floor is yours, please.
Thank you very much, Agnieszka. This is indeed the last session devoted to very important topic, fiscal sustainability challenge during and after the COVID-19 pandemic. And first, I would like to give some outline of this session. Here is the level of general government gross debt to GDP at the end of 2020, according to IMF World Economic Outlook data. And we see that there are most of advanced economies on this graph, and we see that there is quite large number of countries, and there are not small countries, where this level exceed 100%. So basically, the level which was unimaginable 15 or 20 years ago. And this leads us to the question whether the current situation involves the risk of unsustainability of sovereign debt, not in emerging market economies as it happened in the past, but in the key advanced economies. Here, just to remind, is the equation, identity equation, which describes the dynamic of public debt, making some more complicated things, arithmetic things, simple. We can say that the changes in the general government gross debt to GDP ratio can be explained, it can be done practically by changes in primary balance. That is difference between non-interest expenditures and revenue. And or alternatively, changes in the difference between the real interest rate and growth rate of real GDP. And this leads us to the thematic plan of today's discussion. The first question is, does the current public debt at expected dynamics put under question its sustainability? And if yes, under which conditions? The second question is, when should fiscal consolidation start? And what should be the strategy of fiscal adjustment? The third question concerns interlinks between fiscal and monetary policies and their joint impact on inflation. And finally, potential spillovers from advanced to emerging market economies. And we have a very distinguished panel, and I will introduce in order of presentation. First will speak Leslie Lipschitz, who had a distinguished career in the IMF. His last capacity as director of the IMF Institute. Then after retiring from IMF, he worked in private sector. Then we'll have next speaker, Wyplosz, the retired professor of the Graduate Institute in Geneva, but also former policy director in Center for Economic Policy Research in London. And so what is important for organizers of today's conference, member of Case Advisory Council. Then the next speaker will be Gros, the distinguished fellow and member of the board of Center for European Policy Studies in Brussels, and during 20 years director of these institutions, and also member of Case Advisory Board. And finally, Jacek Rostowski, one of the Case founders, former Deputy Prime Minister and Minister of Finance of Poland, whom I had honor working together before he joined politics on several interesting macroeconomic projects. And now, as far as I know, also coming back to teaching Central European University. As I already mentioned, the first person whom I would like to give the floor is Leslie. Please start. 8 to 10 minutes for initial presentation.
Can you hear me? Hello?
I think so.
Yeah, okay. Thanks, Marek, and greetings from the Booth Bay Harbor on the east coast of the United States, where the wind is high and there's a small craft advisory outside my window here. So if you hear some howling, it's not me, it's the wind. I'm going to talk chiefly about the United States, where I live and work mainly, and I want to address three questions. First, is continuing fiscal and monetary stimulus appropriate? Second, whether it's appropriate or not, is it sustainable? That is, what are the long-term implications and what's the exit strategy? And third, what's the plausible worst-case outcome? I mean, there are a number of scenarios one could envisage which would be problematic. I'll pick one and discuss its plausibility. Let me start with some background on the first question about the appropriateness of current stimulus. About 16 months ago, the Open Market Committee of the Federal Reserve was envisaging a post-COVID recovery that would be characterized by disinflation. That is, there'd be a deficiency of demand relative to potential output in the economy. At the time, I wrote an article for Barron's, the investor newspaper, making largely 3 points. First, that any projections, whether by the Fed or the IMF or anyone else at that stage, were not worth the paper they were written on. We were in a situation of pure uncertainty. We knew nothing about the duration and severity of the epidemic, of the pandemic. Second, while projections were worthless, thinking through different scenarios was a useful exercise, because we needed to think both from the point of view of investors and from policymakers how to position ourselves under different alternative scenarios. And finally, despite what the Fed was thinking, the recovery phase of the recession was as likely to be supply constrained, that is, demand to exceed potential output, as it was to be demand constrained. So what's happened? Well, there does indeed appear to be a supply constrained recovery. All sorts of bottlenecks in the economy are stymieing the responsiveness of supply to price and demand signals. My calculations, and which are quite close to those of the Congressional Budget Office, show that potential output, the gap between output and potential output at the end of 2020 was about 3 percentage points. By the middle of this year, that gap had changed. For the next few years in the US, one will expect a rate of growth of potential of around 2%, and I can go into that derivation later if there's some interest in it. But despite the supply constraints that are really emerging in the United States, policymakers have treated this recovery as if it's a pure Keynesian deficient demand recession. Fiscal policy, after the huge stimulus of the Trump administration, has become even more stimulatory. A couple of points here. When the Biden administration came in, the first thing they did was they passed the American Rescue Plan, $1.9 trillion, 8.5% of GDP of additional spending. That on top of a situation where there'd been a buildup in household savings of about 7% above normal, 7% of GDP, 7 percentage points of GDP above normal. When that gets run down, there'll be stimulus naturally from that. So if you take the 8.5 and the 7, we have about 16 percentage points of GDP of stimulus going into a situation where already output is pretty close to potential and is about to exceed potential. Beyond that, the administration has proposed another $3.5 trillion of soft infrastructure and $1 trillion of hard infrastructure. those two bills, together with some tax increases, are with Congress, but will certainly be pared down substantially before they are passed. Whatever the situation is, we find that we have massive fiscal stimulus without the supply capacity to support it at this stage of the recovery. Monetary policy has been equally loose. These are figures that are well known. The Fed balance sheet has gone from less than $1 trillion before the Great Recession to $8.3 trillion now. The Fed continues to buy $120 billion in assets each month. The federal funds rate is in a corridor between 5 and 15 basis points. There is no effective monetary restraint in the system. So what's happened? Has there been disinflation indicating demand constraints, or have there been higher prices indicating supply constraints? Well, clearly the latter. The consumer price index has risen by 5.3% in the last 12 months. The producer price index has risen by 8.3%. Much more shocking, I think, are the components of the indices. If you look at the producer price index, processed intermediate goods have risen by 23% in the last 12 months, unprocessed intermediate goods by 50%. If you look at the 6-month annualized producer price index for final demand, that's risen by 10.5%, with very high numbers across the board for goods, services, private construction, personal consumption. This suggests that either profit margins will be squeezed or the consumer price index will have to continue to rise by well above 2% for the foreseeable future. Also, despite burgeoning evidence of labor shortages and emerging wage pressures, the indices don't yet show any wage inflation effects. When these may emerge, of course, they could have the price increase morph into a sustained inflationary spiral. So these questions obviously require one to question the wisdom of continuing fiscal and monetary stimulus. Let me turn to the second question, the sustainability of stimulus and the exit plan. Getting back to the points Marek made earlier on fiscal policy and the debt dynamics, every now and again someone pops us to reassure us that technically, as long as the interest rate is below the growth rate, their debt ratio cannot explode. This is not very reassuring. In the US this year, general government debt is about 130% of GDP. The primary deficit is above 13% of GDP. Now, let's do a quick scenario. Suppose for the foreseeable future, the government manages to reduce the primary deficit to 4% of GDP. That's down from 13 now to 4%, and to sustain it at 4%. Let's suppose they can sustain real growth at the rate of growth of potential, which is about 2%, and to hold real interest rates to 0.5%, which incidentally is just the number that came out for the federal funds real rate this week in the FOMC meeting. Well, what would those numbers give us? Yes, debt will stabilize, but only after many years and at a ratio of 272% of GDP. But this is just arithmetic. It's just dumb arithmetic. Well, before we reach that level, there'll be a shock of some kind, either a demand shock or at a minimum, there'll be a risk premium shock that will raise interest rates and exacerbate the debt dynamics. Those debt dynamics are highly sensitive to interest rates. If the real rate went up by 20 basis points from 0.5 to 0.7, the debt ratio, the steady state debt ratio, goes up by 30 percentage points of GDP to above 300%. If there's any kind of demand shock, fiscal policy will be completely emasculated and unable to help. If the government tries to halt the debt dynamics and they let us ride for a while and then try to halt the debt dynamics down the road through a fiscal retrenchment, there will be a major shock, a fiscal cliff that might well precipitate a recession. So what we're putting ourselves in is a position where fiscal policy is completely emasculated and constitutes a problem, not a solution. On monetary policy, the longer we wait to exit from the stimulus, the more difficult it's going to get. A tapering of asset purchases or more extreme a reduction in asset holdings will steepen the yield curve with problematic implications that I'll touch on in a moment. At present, the Fed looks like a bank with excessive maturity transformation. On the liability side, very short-term liabilities. On the asset side, medium-term assets. If you try to raise the federal funds rate, you'd have to raise the rate of interest on those bank liabilities, and just at the same time as the value of your assets was tanking. So that wouldn't look good for Fed profits and seniorage transfers to the government. So that's the situation. Well, what's the worst case scenario? And one can think of many bad outcomes that aren't necessarily baseline, but are not crazy. As I said earlier, extrapolations are just dumb arithmetic. One needs to be more imaginative about thinking about what might happen. Well, if, as the Fed and many others think, we just get somewhat higher inflation, say 4% for a few years, well, that's not a major concern. That would not bother me. It'll probably help contain the debt dynamics. It'll probably help reallocate resources to ease bottlenecks. But what about if, as in the 1970s, we lose control of inflation? Recall in the US, also in circumstances when the authorities sought to fix the supply constraint with demand stimulus in the 1970s, inflation hit 11% in 1974 and 13.5% in 1981. This wasn't politically sustainable then, it wouldn't be now. And that brought in Paul Volcker, who raised real interest rates to double digits and crushed the inflation, but with a very bitter and painful recession. What would similar policies now do? I think they'd be much more dire because our financial sector is more fragile. Of course, government debt is 4 times as high, the government debt ratio is then, and higher interest rates would really exacerbate those debt dynamics. Business sector debt then was 53% of GDP. On the eve of the Great Recession, it was 72%. It's now 85% of GDP. And much of that business sector debt is in junk bonds and leverage loans. A sharp rise in interest rates would elicit a spate of private sector bankruptcies and liquidations, and an exacerbation of the government debt dynamics, of course. The stock market would see a triple whammy: higher interest costs, margin compression with reduced demand, and a higher discount rate on future earnings. There's very high margin debt with brokers, and that would prompt a sell-off in the stock market. Now, let me be clear. I am not saying that this is what I expect, that this is the baseline scenario, but it's a not implausible scenario. And the job of policymakers is to make sure that this does not happen. So what should be done? And that's a seminar in itself. First, I think the authorities need to really trim those ambitious spending plans that are on the table in Congress. They need to raise taxes in a way that makes sense. That's a huge topic. The US tax system is a complete mess, and it's unlikely we're going to get significant change with this unless we get some more bipartisan cooperation. They need to taper asset purchases, not next month, they need to taper asset purchases now and tighten financial conditions very gradually. That is something that's going to require great finesse for the Fed to do without generating financial crash. Well, I think I've used up my time. I hope this hasn't been too depressing. It's a bit apocalyptic, but here I am on the coast of Maine. Most of the time, the weather is beautiful, and I try and remember the words of the immortal Bobby McFerrin. Don't worry, be happy. Thank you.
Okay, before passing floor to Charles, I would remind all participants, online participants, that you have opportunity to put question online on the screen. You have such function, so I am, as moderator, I'm waiting for your questions. and my colleagues also will be happy to answer them. Now, Charles, your turn.
Very much, Marek. Let me join everybody to wish a very happy birthday to Case. Case has been an amazing history in Poland, but way beyond. And today, it's a shining light in the country in extending its cooperation with the rest of the world and striving for the best scholarship. And this conference attests to that. So well done, and you're becoming better every day. Now, good. I was going to ask about my PowerPoint presentation. I want sort of. I agree with much of what Leslie said, but I'm less worried than him. Although that doesn't mean I'm not worried. And what I want to do is to send a message that all this discussion about debt sustainability is likely to be misleading. Next slide, please. So Marek already showed the data here. I put together the public debt of the euro area as a whole, and it has this distinct staircase shape, going up, rarely going down, and essentially going up, and now reaching 100% of GDP for the area as a whole. Of course, it's not the case of individual member countries, but I don't have the time to get into that. Now, next slide. The question is, what do we do with that? Now, one answer is get that debt down, back down as soon as possible once the coronavirus has gone away, or at least is under control. A second answer is, well, we've been staying on the ever higher staircase levels. Let's keep doing that. And the third answer is get back down later, but only when the time is right. And that's what I'm going to argue, and I'm going to be a bit in disagreement with Leslie. Next slide, please. Now, people worry about debt sustainability, and you can read every day in your favorite newspaper a statement that this debt is sustainable and that one is not. The short answer is we just don't know what is debt sustainability. We look at the amazing debt of Japan with a negative interest rate, so zero risk premium. Nobody worries about the Japanese debt, and there are reasons for that. You look at the U.S. debt that has been growing very fast, and except for Leslie, just kidding. Market at least seem very happy to buy U.S. treasuries. So these debts have been going up and up and up, and I've always been surprised that nothing happens. Now, the more complete answer is we understand why we don't understand sustainability. We have a very good theory about debt sustainability. It's about taking the equation that Marek showed us and keep moving it further and further in the future, and getting to the condition that the debt will be repaid over the lifetime of the country. Now, that's very nice. That's very clear. Cannot be really argued against. The problem, it's impossible to implement this theory. The expected lifetime of a country is hopefully infinite. And if it's not, we don't know how to compute that. If we look further and further in the future, we look at budget surpluses or deficits, primary budget surpluses or deficits that cannot be planned. Already planning next year or the year after is difficult. If you think 5 years, 10 years, 20 years, there's just no planning possible. So we don't know what's going to happen in the future. So we don't know whether the debt will be repaid. And the key parameters in this equation, beyond the primary budget balance, the interest rates or the growth rates cannot be forecast in the future, far in the future at any level of accuracy. And as Leslie said, the results of any calculations are extraordinarily sensitive to small changes in the interest rates or the growth rate. So the question is, how do we go from here to try to say something that makes sense theoretically and practically? And I'm going to put a few suggestions. Next slide, please. Now, the key problem is the horizon, and that's why that's really my message. We cannot, the lifetime horizon is just impossible to deal with that. So what do people do when they face this problem? Most people use a short horizon, 2, 3, 4, sometimes 5 years. And what they want is that there is some, not the real intertemporal budget condition, but some conditions that are met in the next 3, 4, 5 years. And that usual, and the European Stability Pact is an example of that, but it's all over the place, including in IMF publications and any publication you want to have. The problem with that is you want the adjustment to be done over the 2, 3, 4, 5 years. And that makes no sense because any adjustment has to come over the lifetime of the country in theory. So you force an enormous pressure on the country or the government in the short run. And in practice, it means procyclicality, namely you cut down on deficits just when you want a fiscal policy that is expansionary. Now, if you start looking at long horizons instead, 5, 10, 20 years, 30 years, you come to the conclusion that you have to find a way to commit governments to run that down when the time is right, not before, but as soon as it is right. That's the proper answer. Now, of course, none of these two answers are credible. The short horizon is highly inefficient, and it's likely very often to hurt. And if it hurts, it won't happen unless you put enormous pressure on the government, as has been the case in Europe with Greece, and the IMF has a good record on that, which is not particularly good. Now, the idea of looking in the long horizon means you have to have rules or principles to bring down the debt, which will apply to future governments and their parliaments. And of course, you cannot constrain the government that will be in power 10 years from now. So none of that is credible. Next slide. There is some animation that's not working here. Forget about the blue sentence. Here I put the British public debt from 1727 to now. So it's 400 years of public debt as a percentage of GDP. And what you see, it goes up essentially during war periods. You can find all the wars that Britain has been involved in, plus the Great Depression. And then it's brought down very slowly. So if you look at the Napoleonic Wars in early 1810s, the debt GDP went to 200%, and it took about a century to bring it down to close to 0%. That's the way it's done. It happened again after the Second World War, much faster, because inflation and financial repression was used. But even though it took 20 years. So the message is in line with, you have to think in terms of the long run. You cannot force everything in the short run. And the horizon is in a matter of generations, not years. So my statement here is, when you think about sustainability, don't look at the next 4 or 5 years. Look way beyond, and don't try to do good things for reducing the debt immediately. Next slide, please. Okay, so here a bunch of quick suggestions. I don't want to overstay my time. So first, again, I insist, you need to look in the very far in the future. And when you start thinking about future governments and future parliaments, you get immediately to the idea it's a matter of institutions, to have proper budgetary institutions. You should not try to make assumptions like we do now. So we have assumptions for the next 3-4 years, the short horizon. Even these horizons, the assumptions are usually wrong. Leslie made the point that now any assumption, any forecast is just wrong. I fully agree. So we shouldn't try to forecast, but should make assumption, saying if this and this and this happen, that's what's going to happen to the debt. And you have to task the policymaker to take responsibility for the assumptions they want to make. So if they take too easy assumption, they will be implicitly or even better explicitly committed to those assumptions. Now, the calculation behind these assumptions or the impact of this assumption has to be made publicly by the technocrats. So the government agency, the ministries, the budgetary offices, they should not take responsibility for the assumptions, but they should make it very clear how they reach the result they reach. And then the parliaments, when they vote for or they evaluate the government work on making assumptions, they should endorse them. So the political side of the game, which is crucial, should be committed to whatever they plan in the future. Now, on top, to keep everybody honest, you need the independent fiscal councils, and I think they should advise not the government but the parliament, because it's in our democracies, it's the parliament that vote, and they have that in the US with the CBO. So they should evaluate the assumptions accepted by the government. They should warn that there is a need to change assumptions. So when you have a COVID crisis, assumptions have to be changed. That's totally legit, but it should be done again transparently, and the council should give a view of how reasonable are this assumption, and it should oversee the implementation. And when a new government is elected and want to change everything, the council should have the obligation to Congress to evaluate these proposals. So, next slide should be the end. Yes. So thank you for listening to me. And if I can get the next animation here, if it works. No, you can't. Well, I had planned to turn this picture upside down to show what I hope is going to happen to the debt in the next century in any country. Thank you very much.
Now I would like to ask Daniel to take the floor. Okay, can you prepare screen?
From my side, happy anniversary. And I think you'll still be going strong for the next one to come. So a great job done, and keep at it. My presentation will be perhaps a good complement to what you have heard right now from Charles and Leslie, and I agree with what they had said. But perhaps I can invite you to go away from this thinking 0-1 that is either sustainable or not sustainable. That is my key point. If I can have the next slide, please. And the starting point is something which you, Marek, already said at the beginning. We have very high debt levels throughout the developed world, and we have very low interest rates. Or technically, as you also showed, what matters is the difference between the interest rate and the growth rate of the of GDP. That's R is interest rate and G is growth rate. And why should we worry? And I'm saying that it's perhaps not so much a worry about debt sustainability, but that one should think about the cost of public debt as increasing more than linearly with the level of debt relative to GDP. Technically, this is called convexity in the sense that if your debt level is after a certain time twice as high as before, then probably the cost of that debt is more than twice as high. And this is the main point I wanted to make today. Next slide, please. As already was said, Charles illustrated that very well. Sustainability is extremely difficult to measure. And I just wanted to add a little bit to that in the sense that the situation where interest rates are lower than growth rates is actually not something new. Schullerich has shown that looking at centuries of data. And the second point is that even if you have a situation where interest rates are lower than the growth rates, you could still have defaults. There's a nice piece by Mauro from the IMF who asked whether if R is lower than G, whether we can sleep soundly, and the answer is you cannot. So it's not all a question of R minus G, but to something which I will come to now. Next slide, please. Which is a combination with what I'm saying here and the next slide, which you don't show yet. And the key issue here is that if you have only domestic debt, then there is no net debt at the level of society. If the interest rate or the risk premium on the debt goes up, it means you pay more to your debt holders, but you also have more income in the country because these debt holders often get the higher interest rates. So in that sense, there is no transfer to abroad, no net transfer out of the country. By comparison, if you have foreign debt or debt held by foreigners, I'm abstracting from the currency here. If your debt is held by foreigners and the risk premium goes up, you as a country have to make a net transfer to the rest of the world. And that's, of course, politically much more difficult than transferring income within the country. And the main point I wanted to make, and why I'm emphasizing this, is that within the euro area, which is my main concern, you have very large cross-border holdings. So de facto, very large part of public debt is foreign debt. Keep that in mind because that's important when you have a risk premium, as I said earlier. That is a burden not only on government finances, but also on the country in terms of the net transfer it has to make to foreigners. Next slide. Now here you just see something which I think was already alluded before. If you look at R minus G, you see that until the year 2000 and something, for most of these countries which I show here, Euro area, US and Japan, the interest rate was larger than the growth rate. And then we have, since about 2015, a situation where for all of these entities, the interest rate is smaller than the growth rate. So, and that's, as I said earlier, that's the starting point why many people think sustainability is not so much of a problem. Next slide. Now, the key issue for me is that, as I said earlier, that the cost of debt is not just linear, it increases proportionally to the debt level. And there's one easy way to motivate that. If you say that the interest rate on the debt of the public debt is equal to the risk-free rate plus a risk premium, and if that risk premium depends on the debt ratio, then you get to a situation which you see on the last row here, that the debt service burden is equal to the risk-free rate times the debt, plus the risk aversion, the degree of risk aversion times the debt level squared. Right? So that's what I said earlier. If the debt level goes up, then the cost of servicing the debt more than doubles. I think Charles mentioned earlier that this puzzle why in Japan there's no risk premium, in the US there's no risk premium. We can discuss that later. I'm concentrating here on the euro area, where we usually do see a risk premium if debt levels go very high. So that is one way, maybe the easiest way to say why the cost of debt increases more than linearly with the debt. And the second point is important which is important for me, is that difference, that this effect depends on the degree of risk aversion in the market, which we can see can change enormously over time. We are now in a situation where the degree of risk aversion is very low. So even highly indebted countries in the euro area pay little, but we know that this is not guaranteed for the future. Next slide, please. So what are the consequences of this convexity? The first point I wanted to make is that the average cost hides the marginal cost, meaning the true marginal cost of having more debt is larger than the interest rate. So when people say, oh, just the interest rate is zero, any investment project which has a return which is more than zero is therefore worthwhile for the government. I'm saying that reasoning is wrong because it doesn't take into account the fact that if you have more government debt, not only you have to pay the interest rate on the higher level of debt, but you have to also count with a higher cost on all the existing debt. And that's why the marginal cost of debt is higher than the interest rate. Comment something which is not on this slide, but which is implicit. My reasoning is that the difference between the marginal cost of debt and the interest rate increases with the debt level. Next slide, please. And here I have just an illustration of the overall debt service burden of a country, where I have just the interest burden as a percent of GDP on the vertical axis, and on the horizontal axis I have the debt to GDP ratio, with assuming two different degrees of risk aversion. So let me take the extreme values on the right. If you have a high degree of risk aversion and you have a debt ratio of 220%, a bit higher than Greece today, but not very far, then you would have, in a nervous market environment, you would have to pay a risk premium, as such a high risk premium that your overall debt service burden would rise to 12% of GDP. Whereas if the markets are much calmer, then your interest rates you have to pay on the debt is only about a little bit more than 4% of GDP, which is basically what Greece is paying today. So this figure shows two things. As I said, the cost of debt increases more quickly as you have higher debt levels, and it depends a lot on the degree of risk aversion in the market. Next slide. And one consequence of that is that debt can spiral out of control even with a constant fiscal effort. So if imagine you have a primary surplus, which today would yield you a more or less constant debt ratio. But then if you have a small disturbance, and if initially the primary surplus is no longer enough to cover debt service, then debt goes up a little bit. Next period, debt will be higher. The risk premium will be higher. And with a constant fiscal effort, you spiral even more quickly out of control. I have illustrated that in some previous work. Next slide, please, with my colleague Cynthia, where we just assume here a constant primary surplus of 3% of GDP. We ask ourselves, what happens if a country starts with a debt ratio of 1.5, so 150%? Then you spiral out of control. However, if it were 1.3, which is the green line DO130, then it would be almost stable. And if you were to start with the blue line DO, which is original debt, 110% of GDP, you would actually have to do nothing, and the debt would decline over time. So we have this knife edge property where things can quickly spiral out of control if you're a little bit above, a little bit below. And that is one of the effects, I think, which is very often not taken into account, including in all the calculations which Charles did in his very nice background paper, which he had shared with us before. Next slide, please. So the conclusions are very simple. I wouldn't just look at the debt service today to assess sustainability. I would take into account the marginal cost of debt, which is higher than the interest rate, because as debt level increases, risk premium increase and the probability also of speculative attacks increases, something which I have not taken into account here. So instead of just thinking about is the debt sustainable or not, I would invite you to think about what is the cost of public debt when you are, let's say, already at 150% of GDP. Is it equal to the interest rate, or in reality, is it perhaps much higher? And if it's much higher, do you then make different choices in terms of how you look at future or present deficits, how you look at what governments should invest into, and so on? And this applies, of course, especially if the uncertainty is taken into account, because at least for those of you who know, if you have a convex function and you have uncertainty, then as there's more uncertainty, the probability of extreme events and therefore very bad outcomes increases more than proportionally. That is a little bit behind what Leslie said at the very beginning. So if you already have a very high debt level, you should take very seriously even a small likelihood of a very bad event. So high debt level, in my view, is not a question of sustainable or not. It's a question of the danger it brings for the future and the cost it has already today, because it is more than the interest rate, which in reality will burden society if you start or keep a very high debt level for a long time. Thank you very much. That is all I had to say.
Thank you very much, Daniel. Jacek, your turn.
Thank you very much, and it's a huge pleasure to be here at CASE's 30th anniversary conference. I remember Marek and I 30 years ago, and I think 8 other people, invested the impressive sum of 100,000 old zloty each to set up CASE. That, I think, was $10.50 each. I don't think there were any other injections of capital since then. So in terms of social return on the financial investment, I can't think of a greater rate of return, probably in world history, except for Apple or Amazon or something like that. So, I think we can be proud of ourselves, even though, of course, it was all on a far smaller scale. The second thing I wanted to say is I'd like to look at all of this in a rather longer perspective, because, of course, it's entirely correct to say, as I think I can't remember whether it was Professor Lipschitz or Charles, to say that even if G is greater than R, you can still have a default. Well, obviously, because all you need is for the primary deficit to be large enough for long enough, right? And of course, the temptation to say, well, G greater than R will deal with the problem in the far future is greater the longer G is greater than R. So that's clearly a problem. However, I remain very unconvinced by Daniel's point about convexity, because if we look at the last 10 years, what we have in the advanced countries, and not only in the advanced countries, is roughly a doubling in debt to GDP ratios, or at the very least an increase of 2/3, combined with a collapse in real and nominal interest rates. So while, of course, if you hold enough things constant, Daniel, you can always say that your model works, it's also nice to confront it with the actual facts that we have. And therefore, what I want to talk about a little bit is looking at it in the longer term. Why have real interest rates been so low for so long? There's the well-known phrase, low for long. And is it likely to continue? I remember giving an interview to Reuters in 2011 saying interest rates are extraordinarily low, as they were beginning to be throughout Europe and also for Poland. And I was asked, well, how long do you think this will last? And I said, a long time, 5, maybe 10 years. Well, it's lasted 10 years and they've got lower and lower. And the question is this likely to continue? Now, I want to concentrate on real interest rates in the long term because I think they're more interesting than the question of inflation. I think you could have a situation where real interest rates remain low for a long time and you have significant inflation. I'm enough of a monetarist to believe that inflation is a monetary phenomenon, although of course we know that velocity of circulation changes, so it's not a one-to-one relationship between increases in the money supply and the rate of inflation. But also very importantly, that real interest rates are determined by real underlying forces, right? And the question is, why are these real interest rates so low? And are they therefore likely to continue to be so low? Well, I think, and this is pretty important, it sets the framework, these very low real interest rates that have been around for such an unexpectedly long time, determines the politics of fiscal policy. I remember a politician who said on election night 2015 in Poland, there isn't the money and there won't be the money for the new government's expenditure plans. Those of you who are Polish will be able to identify that person fairly easily. In fact, of course, it was me. And of course, I was right, because, of course, there wasn't the money to finance all of their expenditure plans. They managed to finance some of them. And the main reason they could finance them was that the cost of debt servicing collapsed. And that, of course, not only that effectively reduced expenditure in an enormously important way. So it's very important to work out how long this is likely to last. Now, I think it's worth looking at two things. First of all, looking in the very long term, there's a work for the Bank of England by a young economist called Schmelzing, which suggests that real interest rates have been declining for at least 500 years at an average rate of about between 0.6 and 1.6 basis points a year over that long period. It started off around 20% in the 14th century, and now we know where they are. They've come down in jumps. And the question is there something in an underlying sense happening? And I think there is. There are lots of institutions that have been developed to reduce risk, among them the IMF, but not only, more rule of law, all sorts of things that are really fundamental. Now, I don't want to deal with the problem in that length of time, but I would like to look, let's say, 20 years ahead. And here, I think, the question is, what is causing these low real interest rates? And I think there are two things. The supply of savings has increased, and the demand for investment has fallen. And the demand for investment, I'll start off with that. There's a very interesting paper, again, by the Bank of England, by two economists, Łukasz Rachel and Tom Smith, which shows that the cost of capital goods. What?
Closer to the microphone.
Oh, you want me to be closer to the microphone? Sorry, all right. Is that better? Thank you very much. It's hard because I can't hear myself. So thank you. And this paper of theirs suggests that the cost of capital goods has fallen really quite significantly over, certainly between 1980 and 2000, certainly, and maybe a bit longer, and that's probably by a whole percentage point of GDP. And of course, if the cost of capital goods falls, then at any given price, you've basically got an inward shift in the demand curve for investment. In other words, there's less investment demand because you don't need so much capital for a given amount of labor. And another way of thinking about this is our good friend capital saving technical progress. Now, the problem with that, of course, is that we don't know how future technical progress will look. But for a long period of time, there has been this inward shift in the investment schedule, and it does seem to be linked to better use of capital, right? I mean, information technology reduces the amount of capital you need. Cable allowed for a massive reduction. The cable under the Atlantic allowed for a massive reduction in the amount of grain held on each side of the Atlantic as grain was exported from the United States to Europe. The savings schedule has also shifted out, and there seem to be three main reasons. One that's pushed very strongly by Charles Goodhart and Proudhon is that, in fact, globalization, I'm going to finish fairly fast, globalization has created a huge increase in the amount of labor as China, to some extent India and Central and Eastern Europe joined the world market, and that this is now ending, he claims. Then there's inequality, which by shifting the income towards richer people who save more increases the savings rate. And finally, there's demographics. Goodhart and Proudhon claim that the baby boom generation, if you like, plus the Chinese and the Central East Europeans, will in fact, since they're working, they're saving a lot. They're using a very simple life cycle hypothesis, but when they come to retire, they'll dissave, and therefore the savings rate will go up. Will go down. My apologies. The savings rate will go down and the real interest rate will shoot up. Right? That'll be the end of this sweet spot, this honey spot in as far as real interest rates are concerned. Now, I've actually looked at some of the thinking behind this, doing some fairly simple comparative static economics, and quite frankly, that's not right. It's not true, and fundamentally, because more people in the labour force, you need more capital. And if you've got a baby boom bulge, when they're first working and then they retire, then they don't need that. That capital, the difference between the generations, the working generation and the retired generation, means that you need less capital, and therefore the investment per worker remaining the same, total investment goes down, and there's no reason to suppose that it goes down by more than the savings per worker goes down. And so therefore, there's actually no reason to suppose that either the inflow of Chinese or the inclusion of all those new workers has brought about this fall in the income and will lead to its reversal, nor is there a reason to suppose that aging will reverse the fall in the real interest rate as people move on to retirement. I think that's pretty important stuff. I don't want to go into the details of the reasoning, but I think that really is what lies at the heart of one of the aspects, one of the set of problems that we need to think about. I'm pretty convinced that real interest rates will, in the long run, continue to be pretty low, maybe around 1% of GDP. 1% in real terms. And of course, that still doesn't mean that you can't go bust. It also doesn't mean that you can't have inflation if your monetary policy is wrong. But it does mean that low interest, real interest rate environment may pass for a number of years, 5 years or so. But in the long run, it's likely to return. And that'll be the world in which we shall be operating, which, as I already said, that countries, maybe even the United States, could find themselves in fiscal trouble because they've just overdone it. Thank you very much.
Thank you very much, Jacek. Thank you very much, all panelists, for your presentation. They were excellent, very interesting, very informative. We have small problems because we start a bit later, and also your presentation were a bit longer than initially set time limit. So perhaps before we go to the second round, I would like to ask, are any questions or comments from the audience at that point? Okay, maybe I will ask a bit tricky question. Let's imagine that you become Minister of Finance of Italy. Just now, not 5 years from now, just now. What you would do, even not recommend, but what you would do against all these arguments which were presented? Perhaps I will first ask Charles, can you take this question?
Your mic, Charles.
Sorry, I was saying it's more for Jacek to answer this question. He's got the experience. I don't. But if I were finance minister of Italy, I would do what they are about to do in the next year or two, namely to spend as much as they can of the European next generation money and try to do it in a clean, clever way, which I think that's what they are trying to do. And I would I would struggle as hard as I can to change the budgetary institution. That's what I said. I would have something that would bind a future government. And we have a model of that, which is the German or the Swiss debt breaks. They are very similar. And that works. It works in a different political environment than Italy. I'm fairly aware of that. But I believe that institutions can play a crucial role. So before I leave my office, I would like to leave Italy with a proper legal and, if possible, constitutional set of principles to do the budget right, which means I would hope that 10 years from now, Italy can start reducing its debt. No emergency.
Thank you. Daniel, it's the same question.
As Charles said, Jacek would be much more qualified, and I presume when you say finance minister, you mean also with a party which follows what you are thinking. I would put my eggs in two baskets. One basket would be the one which Charles mentioned. The other basket would be to take a look at the 95% of Italian government expenditure which is not financed by the EU, and try to find savings there. So I think reducing the accumulation of debt already at this point, together with the institutions, I think would be my approach. Let's say putting the political capital 50-50 in both baskets.
Thank you. Leslie, the same question.
Well, I led the IMF mission to Italy in 1998, and they didn't take my advice then. I suspect they won't take my advice now. But I certainly feel somewhat more urgency than Charles does. I mean, with a debt ratio of 156% of GDP, how long can we have the German umbrella keep risk premia down on Italian debt? And when there's risk premia go up, aren't we going to get a real problem? So certainly, I would say one other thing. I very much agree with what Charles said about institutional structures. Let's have independent fiscal councils advising parliaments on what they should do. However, you look at the Congressional Budget Office, which is a very prestigious office in the United States. And during the Trump administration, when we were at or above potential output, the Trump administration completely ignored them and went ahead with large tax cuts. So if, as Charles suggests, we should act countercyclically, wait until we had high growth relative to potential and then cut, that just hasn't happened. We haven't had these independent councils that have been any good. Gordon Brown, I remember in the UK, actually fudged the cycles substantially. He said, no, we've got plenty of excess capacity, when it was quite clear they didn't. So I'm not terribly enthused that we could have an institutional structure that would solve these problems. In Italy, we should be looking all across the board for substantial expenditure savings.
Thank you, Jacek. Everybody hopes that you can have. We don't hear you. No? Microphone.
Now you can hear. Now you can hear. Thank you very much. I said that's an invidious question, but I'll do my best. I mean, first of all, as Daniel pointed out, it's very important to what extent your debt servicing goes abroad. And as we know, in Italy, that's to a fairly limited extent. So Italy is actually in a somewhat stronger position than we usually think of it as being. Secondly, these low real interest rates at zero, with a likelihood of rising to maybe 1% in the foreseeable future, in terms of in the longer term rather than in the very short term of a few years, is essentially what has stabilized the Eurozone. Right? It's not the recovery fund. It's the collapsing in the cost of debt service. So I would tend to agree with Charles that there's scope. Now the question is what you do with the scope, right? And I actually I think that when you've got scope like this, the real thing you should be going for, I know it's very boring and very standard, is supply side reform that increases the growth rate. And it seems that there's a bit of scope for that in Italy. That is really the thing that you could do. Italy has performed extremely badly in terms of growth. And yet there's no reason to suppose that it doesn't have the growth potential that at least France and Spain have, right? Which have performed much better since joining the euro. So I would concentrate on structural changes to increase the growth rate. And I think, and as for the German umbrella, it might be worth thinking about this in the following way. That German umbrella is actually extended over the Germany, because an Italian default would be an even pressure on Italy on the sort of massive scale that we had in 2011, 2012, if it was to be sustained for years, for a number of years, would be extremely dangerous to Germany. And therefore, Eurozone countries are in it together, and it's time that they understood it, particularly the ones with surplus countries. And that's where I think we need the institutions to be developed, which actually seriously combine. That's much more important. I mean, no, I agree entirely with Leslie Lipschitz. I mean, no fiscal council will solve the problem for you, and making them report to Parliament is not going to make a difference, because political parties dominate parliaments. So what we need are European institutions, maybe also anchored at the local level, which allow for the sort of grand bargains that Poland went through in 1989, 1990, through to 95, 96, right? Structural reform for support. It's what the IMF does all the time, but it should be spread over a longer period of time under the current conditions. Or it can be, at least in principle. So it doesn't have to be. Doesn't have to involve the same degree of shock that it had to in the Polish case.
Thank you, Jacek. Any questions from audience? Anders?
We have an online question, one.
I know, but I will answer later.
Thank you. I thought that this was quite interesting. I don't think that one should look upon Italy as a macroeconomic problem at all. I think that Jacek came to the right point here. It's a growth problem. Italy has not had growth on average since 2000 because it has hopeless institutions. And the worst institution is the courts. Last I checked, it was on 120th place in the world in terms of quality of the courts. And then you can't have property rights. So it's the same problem as we have with the post-Soviet countries. You can't invest there. Anybody who has a house in Italy complains about how hopeless the situation is. And then the second problem is education. Italy has the third worst secondary education in the European Union. Portugal and Spain being a bit worse. So, with these two problems, you can't get anywhere. So what we really should call for is the kind of reforms that Ireland undertook around 1990. And I think Daniel knows this better, that this is what the EU program for Italy now really amounts to. And this is what we are hoping to get from Draghi. And I completely agree with what Charles said in the beginning in his presentation, that we should not go for a swift cut in the debt, but we should really push extremely hard for institutional reforms from the EU level. Thank you.
Okay. Before I give you floor, any other question from audience? Before we go to panelists to answer Anders' comment and make some final comments, I will like to a bit extend Anders' comment. Basically, most of presentation concentrated on real interest rate. And I think that here was said everything what could be said at that point of time. But we didn't explore too much in this discussion the question of G, of potential growth rate, or real growth rate. Jacek commented a bit on this question. My doubt is that can we expect meaningful G in the coming, 2-3 decades, given the demographic constraints? Even if individual countries conduct institutional reform supply side, all these reforms are very urgently needed. But even with such a reform, can we have growth, meaningful growth, which will permanently exceed real interest rate? So with this Anders' intervention, my question, I would like to invite you now to final round of comments. Maybe we'll come back to the initial order. Leslie, please
Yeah, thank you very much, Marek. And I'll try and address the points you just made. But first, the point that I think Charles made is that there's no rush. We've got centuries during which we can make this adjustment. That's just slightly too Panglossian for me. The question, he went on to say we should have countercyclicality in our fiscal policy. When we're at potential, we should be withdrawing stimulus. When we're below potential, we should be adding stimulus. That suggests to me now that we should be withdrawing stimulus, at least in the United States, but I suspect also in some other countries. I wasn't suggesting that we have a major fiscal cliff now, but simply that we pare back some of the stimulus that's happening because we're now at potential. So, first point. Second point, and related to what the question you just asked, Marek. I very much agree with my co-panelists here that long-term projections are a dangerous business, but more dangerous for some variables than others. So I think, to Marek's point, when one looks at the long-term projections of growth, take the United States. I know that the labor force is trending growth at about 0.4% per annum. I know that productivity over the last 10 years has been 1.2% per annum labor productivity. If you add those two things together and I get 1.6% potential growth. Now, I might get productivity going up from 1.2 to 1.7 or something, or even 2. But I know that growth, the rate of growth of productive potential is somewhere between 1.5 and 2.25. And those are not variables that jump around. They're pretty steady variables. So I think that's a reasonable extrapolation on which we should base anything else we say. On the other hand, the kinds of shocks we might expect, whether they're demand shocks or supply shocks, those are by their nature pure uncertainty. We can't make projections about those. So we want to be in a situation where we can deal with them. And we can't deal with them by making crazy projections of very, very high growth or some sudden jump in productivity or massive institutional reform. Those things take a long time and aren't amenable to that sharp change. In that context, I would say I'd be very skeptical about projections of savings rate over the long term. Partly for some of the reasons that Goodhart and Pradhan advocate, but also if one looks at just the distribution of price increases over the last 20, 30 years, massively high price increases for medical services, educational services, a whole bunch of things that governments spend on and that the old spend on when you talk about medical services. As the populations age, we're going to be consuming a lot more medical services, and those prices are going up very rapidly. So it's not just a diminution of the effects of globalization and this big injection in the labor market. There are all sorts of other things that will impact the savings and investment ratio of the long term, and projections of those ratios are highly suspect. Final point, in support of Daniel, yes, it's true that Japan has a very, very high debt ratio and doesn't seem to have had any jump in interest rates, but that Japan also has an extraordinarily high savings rate. A similar issue for the United States. Why hasn't the risk premium gone up? Sorry, I mean, Japan interest rates haven't gone up. Why haven't they gone up in the US? Well, at some stage, the exorbitant privilege that we have in the US, the dollar being the global currency, will be eroded. And more quickly, the worse the fiscal outlook, and particularly given what China is now doing with its central bank currency as a means of international settlements, they would like to take over that exorbitant privilege. So I think there's a degree of urgency and a degree more caution required than what some have suggested. Thank you.
Thank you very much, Leslie. Charles, your last word in this panel?
Okay, so many things and so little time. Let me first react to Leslie because he's been raising very interesting issue. React to the argument saying, well, the US is now at its potential, so fiscal policy should be reined in. Right now, the US had a very nice expansion, largely because people were saving what they had saved. Now, when this saving comes to an end, and it has to come to an end, what will keep the economy going? And there's a very serious, and it's not a US question, it's a worldwide question. There is a very serious risk that suddenly, poof, the economy will fall back down. So an expansionary fiscal policy is an insurance, as far as I'm concerned, against this potential double dip. And I'm extremely concerned that many European governments are going to go in this direction. Now, second thing about the US, Leslie knows much better than me, but so you mentioned the CBO and Trump. What's Trump? It's 4 years. Gone. Okay, now the CBO lost influence. Trump made a number of silly tax cuts for the rich and so on and so forth, but that's gone. So the CBO is going to be here. It's been here for decades. It's going to be there for another decades, and it's going to work. Now, same thing for Biden. Biden is here for 5 years, maybe more. We don't know. But this is a man who wants to invest in U.S. infrastructure, which is very dilapidated. So he's got 4 years to do his things, and then the U.S. will have a century to pay back for these investments, and there will be a decent infrastructure in the U.S., which, by the way, will add to productivity. And that's the question that Marek asked, what will be growth over the next 2 decades? I don't know. Now, Marek asked an interesting question, which I will use to make a provocative statement. He said, well, productivity when we have population decline. Look, the solution to population decline is immigration. Now, I can see everybody raising the eyes. When I was a kid growing up in France, it was white country. It ain't no more. That's it. It's gone. It looks like the US. Is creating political difficulties, but the declining population problem is not a problem. You just let people go. I know that's not where your part of the world in Poland is going, but I think it's a mistake. Angela Merkel let in 1.5 million people in 2015. That's helps a lot when you have a declining demography. So demography, it's another issue. It's mostly political. It's not for us. But as an economist, I can think of it as a problem. Finally, Anders' question about Italy, I just want to make a remark. First, we agree, Anders and I, that institutional are crucial. That's why if I were given the defense ministry, that would be 99% of my effort. When I leave, there is an institution that's there for a long time and that will work through the political cycles. Now, on Italy, miserable growth, if I'm not wrong, and maybe Daniel knows better than I do, Northern Italy is growing as fast as any other country in Europe. Southern Italy is a total disaster. It's corruption, it's crime, it's everything. So it's not an Italian institutional problem for the whole country. Italy has a very, very, very dangerous problem which is not new. I don't think it's changing the overall Italian institution that's going to help, but it's dealing with the South. And end of my intervention.
Kushar, Daniel, any last comment?
Yeah, thank you. I mean, I agree that raising G is, of course, the mother of all solutions. But I think Leslie has already illustrated very well that that's a variable which moves around very little, whereas the R part can. It doesn't have to, but it can jump, right? Just as a parenthesis on Jacek's point, yes, the risk-free rate has gone down everywhere, but at almost every point in time within the euro area, I'm not talking about Japan, not talking about the States, within the euro area, where countries cannot print their money, you find a strong impact of the debt, a strong relationship between the debt level and the risk premium, right? The risk-free rate, right, which anchors that, goes down, but you find a relationship which changes over time with the degree of risk aversion in the markets, but that Italy pays more than Germany, other higher debt countries pay more than Germany. That is a constant throughout the last almost 20 years. So it's a question of the difference between the risk-free rate and what you pay as a country. And that was my main point. Now, on growth, let me make just a couple of points. On Italy, just the fact is that, yes, Charles, the north is actually it's more productive than Germany, if you could isolate it. But the growth rates of the north and the south have, over the last 20 years, give or take, been very similar. The ratio between the two has remained constant, right? Now, the south lives mostly of transfers from the north, right? So the motor might be up there, right? But the ratio between the two has not changed. And the other thing I always say is Italy has had this bad court system, even when it was much better off relative to the rest of the euro area. Right? So it's very difficult to explain the deceleration of growth in Italy relative to the rest of the euro area with constant institutions. Right? You have to show why the same bad institutions now suddenly become more important. Possible, but that's a step you have to take, then just say, oh, just better institution, and everything will be okay. And this is, I think, if we are honest as economists, we know very little about growth or what exactly will foster growth in advanced economies. I always reminded of what I learned at graduate school, that saying, okay, there's an easy structural reform and you get more growth. It's like saying there's a $100 bill on the pavement, just pick it up. If it was so easy to pick it up, why has nobody done it over the last 20 years in Italy, right? So it ain't so easy. And therefore, I invite caution at saying, okay, we can push a button and E and G goes up. If we had that button, we would have pushed it a long time ago. And therefore, I think it is still worthwhile to think about the determinants of R and to prepare for times when the risk premium might go up again. That was my main point.
Thank you, Daniel. Jacek?
Well, several things here. First of all, coming back to Daniel's point about risk premia across countries. Yes, of course, he's right to some extent when you look at this cross-section across countries. But the fact is that these debt to GDP ratios have increased very significantly over the last 10 years, and particularly over the last 2 years. And yet, so if you look at it in a time series perspective, you've still got these debt to GDP ratios increasing and the costs of debt servicing going down. And I remain to be convinced that certainly in absolute terms, those spreads are not actually bigger, they're smaller than before. Now, as far as Italy is concerned, your point was very interesting, and the points you made were very interesting, but the fact is that Italy's experience with growth is an outlier. And therefore, it's the Italians who should have a better idea of what they need to do. But you would think that there's scope. If we turn to the rest of the world, the rest of the advanced world, I really have no more idea than anyone else whether there's a great deal of scope for increasing the growth rate in the countries that are not in an Italian kind of situation. And it may well be the case that these things are stable. I think that's very convincing. I remain convinced. On the other hand, I do not remain convinced convinced at all by the point that Leslie Lipschitz made, which is that, for example, old people will need to spend more, and therefore there'll be a lower level of savings in society as a whole. And that whole this whole article, a series of articles in the book now by Charles Goodhart and Manoj Pradhan, it's a cornucopia of ad hoc arguments. The fact is, if we try to have a framework for this, an analytical framework, if people live longer and don't work, they need to save more, right? In general. And if you assume that they have any kind of ability to foresee what the future will be, they will save more if they expect to be retired for longer. It's the life cycle hypothesis is a sort of highly mechanistic and completely assumes away elementary rationality by people and by societies. So I remain completely unconvinced. If you work through the comparative statics of this, what you actually get is a fall in savings if you have a bulge like the baby boomers, when the boomers are pre-labor force. That's when the savings rate falls, and that's when the real interest rate will increase. Afterwards, simple comparative statics show that the real interest rate should remain about constant, and I'm completely unconvinced by. They've thrown 5 arguments to prove their point. They can throw another 10 until they deal with the simple comparative statics. I shall remain very unconvinced.
Thank you, Jacek. Let me now answer one question which came about 20 minutes ago. I didn't put this question because this was addressed to me and I didn't want to interfere in discussion. The question was, Natalia Havrilishin asked what I would do as Italian Minister of Finance. My answer is rather simple and relates not only to Italy. I would start fiscal adjustment already now, starting now, more or less along the lines mentioned by Leslie, gives opportunity to move gradually and slowly and avoid any abrupt adjustment if we wait longer. Of course, predicting future is very difficult, and also as entire our discussion demonstrate, it's very difficult to make any deeply justify forecast or what will be R and what will be G in future. I must say that I am rather pessimistic. Perhaps it's a matter of my background as a former policymaker and for short period of my life, but still, maybe it's a matter of my policy advising experience in many countries. Most of them were not advanced economies. There were so-called emerging markets or transition economies, but still, I saw too much optimism in my life, which then didn't materialize. And I think that we are now in a really very fragile situation, macroeconomic fragile situation, not in individual countries, but globally. It reminds me, if I can use this analogy, walking on melting ice. So far is okay. Nobody sank. But we don't know what is the breaking point when the ice breaks. And it's definitely clear that once it breaks, then any further action is much more dramatic and more difficult. So I would try rather to avoid such situation. I think that comparing to the situation post-global financial crisis, there is much less room of maneuver both in fiscal and monetary sphere, and this must be taken very seriously. I would like to thank all panelists. I think that we really had a great discussion, and I am very happy that you accepted my and Kay's invitation to take part in this, and I hope that this discussion will inspire each of us in our research and analytical and policy advising work. So see you again. I hope perhaps also in person, as lockdown measure will be gradually relaxed, and I would like to thank once again and close this session.